Probably three takeaways. One, the breadth of the declines across all major sectors, services, production and construction. So that broad-based weakness plus a weakness on the trade balance was actually perhaps the most disappointing part of that. Secondly, on a per capita basis, per head basis, actually the performance looks even worse. Actually no growth at all for about 3-4 years on that measure. And if you look at the population growth, which is still very strong in the United Kingdom, that isn't translating through into output growth. That has implications for productivity, for the sustainability of real wages. And then the third and final part, of course, is the degree to which households, which have been showing signs of better consumer confidence because energy prices, they're expecting energy prices to come lower, hadn't really been spending over that key Christmas period. So we knew there was weakness in retail sales. My personal view was that you might see that offset by some additional leisure and hospitality spending. That just didn't come through to the same extent. So households feeling more confident, which is why the Chancellor, the Finance Minister here in the UK, is talking up the prospects for next year, but not yet resulting in them spending the pounds that they're seeing in their pockets.
How do you think the MPC are likely to read this data? Is it a meaningful miss?
Well, I think it needs to be taken into the context of yesterday's inflation data, which was a flat line 4% annual growth, still twice the Bank of England's target. But the softness of output, particularly in an environment where there are some accusations that the Bank of England went too far and too late, they will feel the pressure from that, and also the political pressure. There's a political cycle playing out in the UK, and I think you noted, of course, the Chancellor, the Finance Minister, doesn't normally get involved in commentary on monetary policy. To make explicit reference to that, I felt, was very interesting. But 70 basis points in the curve, it's actually a little bit more than I would expect, but I think the data at the moment has the market not quite sure whether we're going to see that first cut coming Q2 and Q3, and therefore there's probably more data we need to see before those start to sort of firm up.
Well, let's talk about the inflation data. Earlier this week, we had wage growth numbers still sitting north of 6%, still very high. Inflation headline unchanged versus December, coming in at still 4%. I know it was a miss versus expectations. We're still talking about a 4% headline inflation number, core even higher, obviously. Are you of the view that this final mile of inflation is going to be the hardest?
Look, it's a soundbite that a lot of central bankers around the world, let's broaden it from just the UK, are using to try and maintain restrictive financial conditions. They don't want the market to front run that, to be passed through to offered rates for companies and for households. But the history, go back to the economic history of this, when you have spikes to the type of inflation we saw, the idea that you can immaculately deflate back to your target doesn't have much of a historical resonance or pattern. What we do know is that there are echoes effect. And then sort of going back to the UK specifics of how prices are setting, if we go to April, benefits, pensions, loans, rents, a lot of prices are set based on lagged inflation. That tells you there'll be an echo effect, and that last mile, to go back to the phrase the central banks so like, I think will be the hardest because of those, if you like, automatic stabilisers in price setting in the UK economy.